Welcome to the 7 rules of long-term investing that actually work. It's a frustrating reality. Most people who try to invest end up losing money. But the reason might surprise you. It's rarely because they picked the wrong stock. The real culprit is human nature. We're wired with powerful emotions that are terrible for investing. We feel the fear of missing out, or FOMO, and buy into a hot stock at its peak. Then, when the market inevitably dips, a different instinct kicks in: loss aversion. The pain of seeing our portfolio in the red becomes so overwhelming that we panic and sell at the bottom, locking in our losses. It's a cycle of buying high and selling low, driven by emotion and impatience. But here's the good news: you don't have to fall into that trap. Investing success isn't about having a genius-level IQ. As the legendary investor Warren Buffett said, what you need is the right temperament. If you can master a few time-tested principles and control your emotions, you can build real, lasting wealth, no matter how much you start with. In this video, I'm going to give you the 7 foundational rules that actually work. These aren't get-rich-quick tricks or trendy hacks. This is a blueprint for sustainable wealth, backed by decades of history and hard data. We'll break down each rule with real-world examples and actionable steps, so you can stop gambling and start investing with confidence. The 7 rules of long-term investing that actually work. Rule 1. Start early. If there's one concept that separates wealthy investors from everyone else, it's this: understanding the power of compound interest. Albert Einstein supposedly called it the 8th wonder of the world, and for good reason. Compounding is your money making money, which then makes even more money. It's like a snowball rolling down a hill. At first, it's small and grows slowly, but the longer it rolls, the more snow it picks up, and its growth becomes exponential. Time is the fuel for this engine. Let's look at a classic example. Meet 2 friends, Alex and Ben. Alex starts investing at age 25. She invests $5,000 every year for just 10 years, and then stops completely, never adding another dollar. Her total investment is $50,000. Ben waits until he's 35 to start. He also invests $5,000 a year, but he does it for 30 years straight, right up until age 65. His total investment is $150,000, 3 times more than Alex. Who do you think has more money at retirement? Assuming a 7% average annual return, Alex, who started early and stopped, ends up with over $600,000. Ben, who invested 3 times as much money but started later, ends up with only about $540,000. That is the staggering power of a 10-year head start. Time is your single greatest asset, more valuable than any stock tip. Rule 2. Stay consistent. The enemy of a good plan is the dream of a perfect plan. Many investors wait for the perfect time to buy, hoping to get in right at the market bottom. The problem is, nobody can consistently predict market tops and bottoms. Trying to do so is a fool's errand. A much more powerful strategy is to invest consistently, no matter what the market is doing. This is called dollar cost averaging. Let's say you commit to investing $200 every single month. When the market is high, your $200 buys fewer shares. But when the market drops, that same $200 buys you more shares at a discount. Over time, this strategy smooths out your average purchase price, and more importantly, it removes emotion from the equation. You're no longer trying to outsmart the market, you're just executing your plan. Think about the 2008 financial crisis. Investors who panicked and stopped their monthly contributions missed the chance to buy stocks at bargain basement prices. Those who stayed consistent kept buying all the way down and all the way back up, supercharging their returns during the recovery. The best way to ensure this happens is to automate it. Set up an automatic transfer from your bank account to your investment account every payday. Pay yourself first before you even have the chance to spend it. Consistency turns market volatility from a source of fear into an opportunity. Rule 3. Diversify. You've heard the old saying, don't put all your eggs in one basket. In investing, this is the golden rule of risk management. But true diversification is more nuanced than just owning a few different stocks. Owning shares in 20 different tech companies isn't diversification, it's concentration. If the tech sector takes a hit, your entire portfolio goes down with it. Real diversification means spreading your money across different asset classes that behave differently in various economic conditions. This includes a mix of stocks, bonds, and maybe even real estate or commodities. But you can go deeper. Within stocks, you should diversify by geography: US, Europe, Asia, by company size, large cap, mid cap, small cap, and by sector: tech, healthcare, financials, energy. Think of it like a balanced diet. You can't live on just protein no matter how good it is for you. You need a mix of carbs, fats, vitamins, and minerals from different food groups to be healthy. Your portfolio is the same. A historical example is the lost decade from 2000 to 2009. The US stock market, as measured by the S&P 500, delivered a negative total return. But investors who were diversified into international stocks, emerging markets, or bonds actually saw positive returns. Diversification doesn't guarantee you won't lose money, but it's the most effective way to protect yourself from catastrophic losses in any single area and ensure a smoother ride over the long term. Rule 4. Keep costs low. This might be the most overlooked rule, but it's one of the most impactful. Investment fees are like termites, silently eating away at the foundation of your wealth. A 1% or 2% annual fee might not sound like much, but over an investing lifetime, the damage is devastating. Let's run the numbers. Imagine you invest $100,000 and it grows at an average of 7% per year for 30 years. With a low-cost index fund charging a 0.1% fee, you'd end up with about $735,000. Now let's say you invested in an actively managed fund with a 1.5% fee. That same investment would only grow to about $485,000. That seemingly small fee difference cost you $250,000. This is why John Bogle, the founder of Vanguard, was such a revolutionary. He created the first index fund for individual investors, built on a simple idea. Instead of paying expensive managers to try, and usually fail, to beat the market, just buy the entire market through a low-cost fund that tracks an index like the S&P 500. These are called passive funds. When you're choosing an investment, one of the first things you should look for is the expense ratio. For broad market index funds or ETFs, you should be paying well under 0.2%, and often under 0.05%. Remember, fees are one of the only things in investing you can actually control. Every dollar you don't pay in fees is a dollar that stays in your pocket, compounding for your future. Rule 5. Reinvest dividends. When you own a share of a company or a fund, you're an owner. And as an owner, you're often entitled to a share of the profits, which are paid out as dividends. For many new investors, it's tempting to take this cash and spend it, but that's a huge mistake. Reinvesting your dividends is a powerful way to turbocharge your compounding. When you reinvest a dividend, you use that money to automatically buy more shares of the same investment. Now you own more shares, which means the next time a dividend is paid, you'll receive a slightly larger payment, which you can then use to buy even more shares. It's a virtuous cycle that dramatically accelerates your portfolio's growth. Think of it like a fruit tree. You can pick the fruit each year and eat it, which is nice. Or you can take the seeds from that fruit and plant them to grow more trees. In a few years you won't have one tree. You'll have an entire orchard, producing far more fruit than you started with. Historically, the impact is staggering. Since 1960, reinvested dividends have accounted for over 80% of the S&P 500's total return. Without them, your growth would be a fraction of what it could be. The best part is that this is easy to automate. Most brokerage platforms offer a dividend reinvestment plan, or DRIP. Just check a box, and it's done for you, ensuring your wealth-building engine is always running at full power. Rule 6. Stay the course. The stock market is not a smooth, straight line up. It's a wild, unpredictable ride with terrifying drops and exhilarating climbs. Your ability to simply hang on during the scary parts will determine your success. This is where temperament trumps intellect. Our brains are hardwired with a powerful bias called loss aversion. Studies show that the pain of a loss feels twice as intense as the pleasure of an equal gain. This is why market crashes feel so apocalyptic. When your portfolio is down 30%, your instincts scream at you to sell and make the pain stop. This is the single most destructive mistake an investor can make. Look at the COVID-19 crash in March 2020. The market plunged over 30% in just a few weeks. It felt like the end of the world. Investors who panicked and sold at the bottom turned a temporary paper loss into a permanent, real one. But those who stayed the course, who trusted their long-term plan, not only recovered all their losses but saw their portfolios soar to new all-time highs within months. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." Think of investing like a long-haul flight. You will hit turbulence. The cabin will shake, drinks will spill, and it might feel scary. But you don't grab a parachute and jump out. You trust the pilot, and the engineering of the plane to get you to your destination. Your investment plan is your pilot. Trust it and stay in your seat. Rule 7. Have a long-term plan. All the other rules we've discussed are tactics. This final rule is your strategy. Investing without a plan is just gambling. You wouldn't build a house without a blueprint, and you shouldn't build your financial future without a written investment plan. This plan doesn't need to be complicated, but it must answer 3 key questions. First, what is your goal? Be specific. Is it for retirement, a down payment on a house, your kids' education? Second, what is your time horizon? When will you need this money? The answer to this question is critical. Money you need in 5 years should be invested very differently from money you won't touch for 30 years. Third, what is your risk tolerance? How much volatility can you stomach without panicking? This will determine your asset allocation, the mix of stocks and bonds in your portfolio. For example, a 25-year-old saving for retirement has a 40-year time horizon. They can afford to take on more risk for higher potential returns, so their plan might call for a portfolio of 90% stocks and 10% bonds. In contrast, someone who is 55 and planning to retire in 10 years needs to protect their capital. Their plan might call for a more conservative 60% stock, 40% bond allocation. This written plan is your anchor. When the market gets choppy and the news headlines are screaming, you don't have to think. You just look at your plan and stick to it. It's what keeps you calm, focused, and on the path to your goals. So let's bring it all together. Start early to give compounding its fuel, time. Stay consistent with automatic investments to turn volatility into an advantage. Diversify across different asset classes to protect against disaster. Keep your costs brutally low, because fees are a guaranteed loss. Reinvest your dividends to create a self-accelerating growth machine. Stay the course through market storms, because patience is rewarded. And tie it all together with a written long-term plan that guides your every decision. Notice how these rules work together. Starting early is useless if you don't stay the course. Diversification won't save you if your fees are too high. They are a complete system. Building real, generational wealth isn't about finding the next hot stock, timing the market perfectly, or being a financial wizard. It's about discipline. It's about having a simple, proven plan and sticking to it with unwavering consistency for years and decades. It's boring, and that's why it works. This path is available to anyone willing to follow it. If this video gave you the clarity and confidence to start your journey, drop a like, share it with someone who needs to hear this, and subscribe for more straightforward, no-hype financial guidance.